August 9th, 2024. Today was a pretty good example of a couple of things, actually. I got to add my nested wedges. Sorry. I forgot about that one. But we had a nested wedge today. One, two, well, I'll just delete this. We had a nested wedge today, which is pretty interesting. You can see the bigger wedge, one, two, three, and then the smaller wedge, one, two, three. So nested wedges and a failed reversal, failed breakout outside of, sorry, not a failed reversal, a failed breakout above this trading range and a reversal back into it. So I thought that was a pretty interesting pattern that we had today. I just feel like I haven't seen many of those lately, but maybe I'm wrong. But I don't know. I thought that was cool. We also had a high two on the open, and earlier in the week, I said this that we might get some sort of similar pattern. It would, instead of the parabolic wedge, well, we did get a parabolic wedge. We got a high two on the open and then a parabolic wedge. One, two, three, one, two, three. And then it ended up being a pullback. And, it wasn't quite a spike in channel, but we did get a high two on the open and then a parabolic wedge. And a lot of times the market will repeat patterns that it had earlier in the week. You can see we had a high two on the open, high one, pullback, high two. We had a low two. And I think we had one other day where there was a high two on the open. Nope, I'm wrong. Okay. But we had, the patterns you get early in the week, you should pay attention to and keep them in the back of your mind on Thursday or Friday. So oftentimes if you get a pattern on Monday or Tuesday, the market will try to repeat that pattern in some way on Thursday or Friday. And again, it's not always exactly the same. And, there are different nuances within that idea, but just overall in general, if you get some sort of high two on the open early in the week, and then it's Thursday, Friday, look for that high two on the open again, or low two on the open, either way. Bar one, so coming into the day, the prior day was a bull trend day. So you have to be expecting we're going to get a couple hours of at least sideways to down trading, but we had a lot of sideways trading coming into the end of the day. And you can see it was an expanding triangle. So we have an expanding triangle into the end of the day where you could use this. Either one is fine, whatever you would like. So this and that, or this and that. So expanding triangle. So potentially a final flag for the bulls. So we'll see what we get. But the reason why you can't sell these big bars 3 and 4 is because you're selling the bottom of the trading range, right? The bottom of the expanding triangle down here is the bottom of the trading range. So you don't want to be selling with big risk with these big bars down at the bottom of the trading range. You instead would probably prefer to be buying reversals up. Bar one, a bull bar, but a tail on the top and a tail on the bottom. There's probably buyers below and probably sellers not too far above. It's probably better not to do anything because if you are doing anything, you're probably trading in the middle of the trading range. So for me, I would just rather wait. If anything, you're probably buying below bar one, but again, I think it's probably better just to wait in this situation. Bar two, consecutive bull bars, a big tail on top of one and on the bottom of one, and a big tail on top of two and the bottom of two. So this is probably more of a minor reversal up and some sort of test of yesterday's close. I don't really think that there's any reason to buy this close. I think we're probably going to go sideways to up, if anything, and more likely just sideways like we ended up doing. A big bear bar closing near its low on bar three. So that's good for the bears. We're probably going at least a little bit lower. However, if you're selling below three, first off, it traded below two. So your signal bar is now two. This could be some sort of second leg trap. You can see, we got the first reversal down here to the open of the day, and then a second leg down here. So it was exact. I didn't know if that was exact. Let me just draw it again. But you can see the reversal down started up here, and the move down lasted to the open of the day. And then we got a second leg down here. So if you were selling below four, you were selling the exact low of that second leg. Do you need to know this? Not really. What you need to know is that it's 2 legs down. I didn't do that measured move out real time during the day, but I obviously noted the gap down is leg one. And so 3, big bar, big risk. And you're selling, your signal bar is bar 2. So your entry bar is bar 3. And you don't really want to sell below a big bull bar like bar 2. So probably more buyers than sellers down here. 4 consecutive bear bars closing near their lows. But, are we always in short? I don't know, maybe, but it's really not all that great. Even if we are, it's probably more towards the bottom of the trading range. This expanding triangle is important. This is the current range of the day is going to be within this expanding triangle until we can get a clear breakout above it. So until we get a breakout above yesterday's high, or a breakout below the bottom of the expanding triangle, it's probably better to treat the day as a trading range open and look to buy low and sell high. So yes, consecutive bear bars 3-4, potentially always in short, but really big bar on 3 and then shrinking body 4, and the risk is still really large. And also, 4 has a tail on the top overlapping 3. So, and 2 and 3 overlap each other a lot. So there's a lot of overlapping bars here. You're selling with big risk at the bottom of a trading range. Probably not worth doing. Reversal up bar 5. It's a high 2 on the open. It's reasonable for bulls to take the buy above bar 5. You can do it for a swing. It's probably not high enough probability to do for a scalp, but there's plenty of times where we've seen high 2s on the open, and they end up being the lows or the highs of the day. I have a bunch of those patterns in here. We'll just go over like 4 or 5 of them. Not all of them look the same. You can see high 1, high 2, high 1, high 2. I think this was a low 2, low 1, pullback, low 2, high 1, high 2. So they don't always end up being the low or the high of the day, but whenever you get a high 2 or a low 2 on the open, they can oftentimes lead to a swing. This week, we got 2 of them. Like I mentioned, we got one during the bear trend day, this low 1 here. So below the 950 bar. Sorry, I don't have the bar number on here, but below here is a low 1 and then an outside up bar and then a low 2 short here. So we got another low 2 high 2 on the open with bar 5, traded above bar 1, the high 1, a pullback, and traded above the high 2, bar 5. It's a bull bar closing near its high. It's a reasonably big bar, but it's not so big that it's not worth buying. So you can definitely take it for a swing. The problem is bars 3 and 4 are relatively big. So you know that even if you are buying above 5, and even if you do get the swing, it's probably not going to go straight up. So it's okay to take the buy. And, I did take it and I put a stop below this bar. You probably don't have to put a stop below here. You can probably just put a stop below 5 because your premise is it's the low of the day. But I figured if it was a trading range, sometimes trading ranges will go below the second lowest support and not the lowest support. So in case we dipped just basically one tick below 5 and then reversed up sharply, I just put a stop below here just to account for that. Because it's not much more risk and it's a lot harder to get back in than it is to just risk the extra 1 point when your swing profit would be greater anyways. So 6, disappointing for the bulls, but relatively expected after bars 3 and 4. The bulls are hoping we're going to get an upside breakout of the expanding triangle, and bar 6 is a breakout pullback. The bears are hoping that 5 is a breakout pullback from bars 3 and 4. Now we're going to get a downside breakout. But to me, with how big the tail is on 6, this shows me that bears, 1 second, I'm going to sip of water. 6 shows me that bears were not interested in selling in this area. They were more interested in buying back their shorts. So as 6 was dipping down, the bears started taking profits, or, the ones who scaled in were taking profits. I assume they sold around a 50% correction, something like that. So that's actually kind of interesting. If you were buying above 5, you were buying at exactly a 50% correction of bars 3 and 4. So another reason why the market might go sideways before it would go down. I still think the overall premise for buying above 5 is strong enough that you can do that anyways, but that is another reason why the market might go down a little bit more. But you can see the bears down here, we're buying back shorts. So that's causing a big tail on the bottom of bar 6. Probably buyers not too far below 6. The reality is bar 5 is really strong. And, if this is early in a bear trend, if you're a bear and you're hoping 3 and 4 is early in a bear trend, you should not be getting a bar as strong as bar 5. It's completely reversing 4. So you should not be getting a bar as strong as bar 5. It's doing more than even just reversing 4 because it's such a strong bar and 4 has such a big tail. So bar 5 is really, really strong. So I think the best case for the bears right now is a trading range. So it's really not all that good to be selling anywhere in here. This is the buy zone. 6, a bad low 1 short for the bears. They're hoping 5 is a breakout pullback, but probably more buyers than sellers below 6. You can see on 7, we traded below 6 and traders bought the low 6 and we ended up getting a huge outside up bar. Why do we get the huge outside up bar? I think it's mostly due, if you're a bear, some bears were really hoping that we were going to get a big bear bar closing near its low on 6 and that we were going to start some sort of swing down. Or even, some of them were probably hoping that they could just get out at break even. If they sold below 4 and they scaled in at 50%, they were hoping they could exit their first trade at break even and their second trade with a profit. And when 7 starts to reverse up, they're thinking, oh gosh, I might be trapped. We're going to at least the 5 high since that's a reasonable swing trade. So those traders just start buying back their shorts at the market. And that makes bar 7 a huge bull bar, huge outside up bar. Bar 7, It's a big bar, big risk if you're buying above bar 7. So you have to realize the market's going to go sideways first. However, it is credible to take the buy above 7, hoping that we have seen the low of the day. But again, you have to realize the market is very likely going to start to go a little bit sideways before we rally. But really strong bull bar 5, really strong bull bar 7. It's reasonable to think we've seen the low of the day and we're going to get an upside breakout here, maybe some sort of measured move up. At this moment in time, the measured move that's visible would be this, because this is the top of the bottom of the trading range to the top with bodies, and you can see that's where the measured move ended up going. We also, when we got the breakout 45, 46, we got a measured move up of those two bars, and that's where the exact top was. But there was a couple of measured moves in this area, so it was a reasonable area for all of the profit taking that we got. Again, trending trading range day. I don't remember if I went over at the beginning of the day, but the definition of a trending trading range day is when you get one trading range and then a 4 or 5, 6 bar breakout, and then the second trading range, and the low of the second trading range is usually around the high of the first trading range, and that's what we got. So trading range, breakout for the bulls, and then a second trading range. So outside up bar 7, big bull bar closing near its high. The problem is big bar, big risk, and you're buying towards the top of the trading range. But I think we're always in long, and I think we're going higher. The pullback on bar 8, it's not all that surprising that we got the pullback on bar 8. Because, like I said, bar 7, so big and climactic that you're probably going to get some profit taking here. But again, it's still reasonable to stay long, hold long, and buy the close. So 8, pullback. It's a low too short for the bears. They're hoping, 5 and 7 are just a pullback from the bear trend starting at 3 and 4, because their stops have technically not been run above the 2 high, or if they had them above yesterday's high. But these bars are way too strong. I do not think that that is the case. It is important that bar 8 low overlaps the bar 6 high, meaning the bears who shorted above bar 6, and even if they saw 7 and were worried about their position, they were able to get back or sell out of their longs around buy back their shorts around break even during bar 8. Bar 9, a huge bull bar, a big tail on the top. This is a parabolic wedge, right? It's pretty clear. 1, 2, 3. So it's a pretty clear parabolic wedge. What does that mean? Well, it means, we're probably going to get some sort of bear bar on bar 10, and, it's probably going to lead to a couple of legs sideways to down. However, it's still reasonable to be long, betting that we've seen the low of the day. If we have seen the low of the day, you know that the daily range is probably going to double. 1 second. So the daily range is probably going to double. So it's probably going to go somewhere up here, at least, right? Bare minimum. And currently, when you see bar 10, the argument would be, you could scalp a piece on bar 9. It's definitely not wrong to. If you bought above 5, you were able to make almost exactly 20 points total during bar 9. So a lot of traders just decided to take their 20 points and get out of the trade, which is a reasonable thing to do. This is a trading range open, and we're getting a parabolic wedge towards the top of this trading range. So you can definitely do that. But if you're holding long below 10, your risk is 20 points and your reward is about 40. So you have 2-to-1 risk reward if you're holding long below 10, which is probably enough to make it viable to hold long. You definitely can get out below 10, but if you're going to get out below 10, it might make more sense to just when you see 9 and you see the parabolic wedge, just take at least half profits on the close of bar 9 if you're going to get out below 10. But reasonable to take profits on bar 9, a big climactic bar. Again, potentially some sort of head and shoulders top. 1, 2, 3, but I don't really think it's worth, I view it more as a parabolic wedge. I think a parabolic wedge is a more accurate assessment of what's going on here and the forces that are at play than a head and shoulders top. 10, a bear bar closing near its low. So it is a parabolic wedge, and you get a big bear bar closing near its low. We're going to get a second leg sideways to down. So if you're going to hold, again, you have to keep in mind we're going to get the second leg sideways to down. Your premise is that this is the low of the day. So if you're holding through 10, you need to wait and see until we break out above the bar 9 high, or we break out below the bar 5 low, and then you can make a decision as to what to do. But we're going to break out above one of those, above the bar 9 high or below the bar 5 low at some point today. Bar 11, disappointing. Again, it's not all that surprising because although it is a parabolic wedge, the bull bars were really, really strong. So I'm not all that surprised that we're going a little bit higher here. Would I sell below? It's a bad low one short for 11, but it's a bad high one buy. Again, you see this, you're expecting a second leg sideways down because of the parabolic wedge. So if you're short, you knew that you were probably going to get a pullback, and you're now looking for some sort of exit, maybe at 1-to-1 of your true risk somewhere down here. 12, a bear bar, but a big tail on the top and a big tail on the bottom. It's an inside bar, so it's a low one short for the bears. But if you're selling for that second leg down from bar 10. And it's really not a very good bar. There's a big tail on the bottom and a big tail on the top. So it's really not worth taking that kind of short. So for me, I would just rather be flat or long. I still think, I'm not really that convinced we went always in short in here. Again, it's definitely reasonable to get out of your longs, but you don't have to. And I'm not all that convinced we really went always in short in this area. I think we probably stayed always in long. We probably flipped to always in short in here and then went back to always in long. And obviously then we went always in short over here. So 13, a big bear bar, but a tail on the top and a tail on the bottom. So, if you're selling in here, you're just selling the middle of a trading range. It's not worth doing. It's disappointing for the bulls because this is a reasonably tight channel. It's probably tighter than you wanted it to be. But the reality is this is 1, pullback, 2. So you're probably still within a trading range. It might be 2 legs down towards the bottom of the trading range. And then you get a reversal up on 14. The problem with 14 is there's a huge tail on the top and a huge tail on the bottom. So even if we start to bounce, it might be more of a minor reversal. It's really not all that great. But yeah, high 2 for the bulls, I think, at least, because, you could argue it's a high 1 because we never traded above anything else here, but we did get a reversal attempt on 11. So you can make an argument it's a high 2, but the thing is, it's still a 5-bar bear micro channel. So it decreases the odds. So yes, I think you can still argue it's a high 2, but it might have a probability a little less than a normal high 2 and a little closer to a high 1. And it's still an issue that there's a big tail on the top and the bottom of 14. 15, a bull bar. There's probably buyers below. Maybe we get a third leg down. 1, pullback, 2, pullback, maybe 3. But if we do get a third leg down, there's going to be buyers below 15 scaling in lower, and they're probably going to make money. So it's really not all that great to take any shorts in here. 16, disappointing for the bears. I think, a lot of the bears, they saw 15. They were hoping for a good short. And they know that the bulls are going to buy below 15 if we go below it. So they just disappointed and they start buying back their shorts at break even. They just start buying back their shorts in the close of 15. And the bulls who were long for any reason, who were looking to buy below 15 are going to buy, at the market as 16 starts racing up because they weren't able to get filled below 15 since we got a micro gap up on 16. 17, another bull bar. So we have a tail 15, we have tail 14, 15, 16, 17. So what is that a sign of? It's a sign of pullbacks on a lower time frame. And it's a sign that this might be more of a channel instead of a bull trend. So, as good as it looks for the bulls to get the 4 straight bull bars, and yeah, we're probably going at least a little bit higher. It's really not quite as good as it could be because of all those tails. And then we get the biggest tail, bar 18. So disappointment 18, we have a wedge forming. 1, 2, 3. And you can see we tried to break it above the high, so potential nested wedge, 1, 2, 3. So 18, it looks like a low 1 short for the bears, and it's a bull bar. So you don't really want to sell below it after this many bull bars. But, while the bars aren't good for the bears, I think the context is becoming reasonably good for the bears that we're going to form some sort of wedge here. I'm curious about something. I just want to see if the parabolic wedge created a leg 1, leg 2. Yeah, so this is the kind of funny thing about trading range days is the leg 1, leg 2s, they're everywhere. Again, I've mentioned before, but I used to spend so much time just scrolling through trading range days and looking for leg 1, leg 2s all over the place. And if you really look for them, they're everywhere. But it's not an overly useful skill to have. But I just did it for so long that I see them all over the place. But you can see the parabolic wedge is a spike of some kind on a higher time frame. And so it ends up being the leg 1. And then you get a deep pullback. Pullbacks in trading ranges are often deeper than you want them to be. And in trading ranges, the measured moves are often leg 1, leg 2s. And so we get a measured move, or we get a parabolic wedge, and then a pullback, and then a second leg up for the bulls. So that's another reason why we reversed up here. 19, a bull bar closing near its high, but it's the first strong bull bar in this whole trend up from 14. So to me, it looks more like a buy vacuum test in an area where traders are going to take profits. Additionally, it's not an inside bar. It breaks above 18. So 18 is your signal bar, and 19 is your entry bar. And again, but more bothersome than that is all of the tails. This looks like a climactic breakout bar to me. So when you're getting the breakout bar high in the range, what do you need? You need follow through. You need 19 to be a big bull bar close, or 20 to be a big bull bar closing near its high as well. And it's just not that. It's a bear reversal bar. So now what do the bears have? Bears now have a parabolic wedge. The bears have a nested wedge. 1, 2, 3. 1, 2, 3. And a reasonable short setup. You can sell below 20 for a swing. you're probably going to get at least a couple legs sideways to down. This is trading range price action, so you have to be expecting that the bad signal bar high in the range might end up being the one that ends up working, even though it doesn't look all that good. 21, another bear bar, but a tail on the bottom. So probably sellers not too far above 21. If we do get above 21, and you're expecting at least a second leg sideways to down, reasonable to be short. The context, we're probably still always in long from the rally up to 19, but I would rather be short than long at this point. So while while the bars might be always in long, I think the context calls for more always in short. 22, an inside bar. It's a low one short for the bears, but it's a bull bar. So I don't think most traders want to sell below a low one bull bar, inside bar that we got on bar 22. So it's still okay though to be short, betting on a second leg sideways to down. 23, a bear bar. We have tails 20, 21, 22. This is classic trading range behavior. I assume we got back into basically the middle of the trading range. Yeah, around here. Basically ended up back in the middle of the trading range where we found support. Because the middle of the trading range, the probabilities are never quite what you want them to be. 24, big outside down. What do the bulls want on 24? Well, they're hoping this is a second leg trap. Maybe leg one, since we never traded above any other bar. So maybe leg one, bar 20 through 23, and then big outside down, climactic second leg trap 24. Or this is leg one, pullback, and then leg two, 23, 24. Either way, the bulls clearly want a second leg trap here, and they know it's towards the middle of the trading range. What do the bears want? Well, the bears acknowledge that it might be a second leg trap and that this is pretty strong and probably going to get a second leg up. However, it's also credible to think that this was the high of the day. The parabolic wedge, the nested wedge, was reasonable to think it was the high of the day. The signal bar is not all that great, so it might not be. Usually, if you're going to get some sort of trend, you'll get some sort of like clearer breakout pattern, like the high two with the really strong signal. So usually this will be stronger than this, but it's still possible that we've seen the high of the day at this point. So some traders will sell below 24, taking a chance that we end up getting back to the 4 low, maybe this low, and potentially that we got this spike, and then the trading range started here, and this was just one more leg up. The bulls have done a good job of making it seem like, this was first off kind of a trending trading range. We had trading range, a couple bars of a breakout, and then a second trading range, and the trading range continued, a couple more bars of breakout, and then another trading range. So I think it's something called the stairs pattern. I don't know. I don't know the technical name for it, but it's doing something like that. 25, a big bull bar closing near its high. Do you buy above 25? I personally would not. It is a high two for the bulls, but you're buying pretty high in the range. I think if the bulls were going to get a really big rally, they probably would have already done it. And the channel down from 20 to 25 is relatively tight. So for me, I don't think buying above 25 is all that worth it, unless you're using a wide stop like below bar 14. And you can see we never ended up triggering above 25. So big bear bar 26, it trades down below the bar 24 low. Some bears who sold the close of 24, they scaled in more during 25, and they're using 26 to buy back their shorts. Other bears, they sold the close of 25 with a stop one tick above 25. So they're really only risking a tick if they got filled perfectly. But let's say for the sake of argument, you're probably not going to get filled perfectly. So they might be risking 2 or 3 ticks. But even if they are risking 2 or 3 ticks, their reward would be 7 points, whatever it would be. So, basically getting 7, 8 to 1 risk reward. So it's reasonable to take the sell. You don't have to win that much of the time in order for you to make money. And so what are the bears hoping? Well, they're hoping that the other bears down here aren't going to buy back their shorts and we're just going to keep collapsing. But it might be 1, pullback 2, pullback 3. So it's possible 26 is the third leg down. We're also in the middle of the trading range. So it's probably reasonable to be short right now. I probably would not be long, but I think it's probably a little more reasonable to be short in this area. 27, a bull bar, but a big tail on the top and a big tail on the bottom. So not really a very strong buy. Yeah, it's still a high 2 or a high 3 for the bulls, whatever you want to call it, but it's right on the moving average. The moving average is not very indicative of anything right now. It's more flat than anything. Again, it went up a little bit, but it's really, it's a relatively sideways area, so it's really not worth doing anything. 28, another bull bar, but a tail on the top. So disappointing, probably sellers not too far above. Again, this whole thing moved down 20 through 27, 20 through 26 could be a big leg one. Oftentimes in trading ranges, I suppose, this is helpful for the leg counting thing, but oftentimes in trading ranges, if you go and look for measured moves, you get a big, leg one, pullback, leg two. Oftentimes in trading ranges, you do get, bigger legs like that, and they're more complex legs rather than just the smaller legs and the more obvious legs where it's, things like, I'm just looking for an example of what I'm talking about. Well, I guess, 30 and then pull back and then second leg down. That's a poor example, but you can understand what I'm saying. Sometimes the legs are more complex. I don't think this was another exact measured move, but I don't know. Relatively close. Very similar area. So probably this ended up being leg one, pull back, leg two. 29, another bull bar. It's a problem for the Bears that we have 3 straight bull bars. We probably should not be getting 3 straight bull bars if this is going to be some sort of bear trend. But again, also 25 really strong, so that goes against the Bears' case. But again, we're probably not going much higher. I'm expecting us to form some sort of lower high here. So I don't think we're going that much higher without getting a deeper pullback. And then a big bear bar closing near its low 30. What's causing 30? Well, some bulls are buying early as we're starting to rally during 27, 28, 29, waiting for a bull bar closing near its high, and they just never get it. Some bears, they're getting better risk reward now selling the market with a stop above 20, betting we've seen the high of the day, so that's reasonable. And I think it's more just bulls giving up, and you get a big surprise bar on 30. It's good enough for a second leg sideways to down. I don't know how much lower we go, but probably at least a little bit. An inside bar 31. So a low one short, but a bull doji bar. So who wants to sell below a bull doji bar? Probably not too many traders. How much lower are we going? I don't know. If you look, we had the spike yesterday, and we've pretty much been forming, higher low, higher low, higher low, higher low, higher low, and then end up getting another one. So we've pretty much been forming higher lows and higher highs since yesterday. So this is a spike, and this whole thing seems like it's part of a big bull channel. So we keep forming the higher lows and the higher highs. So it's reasonable to think that we're going to continue to do that. So it's possible we don't fall below here or we don't fall below here if the bull channel is still valid. So probably buyers not too far below here. 32, a bear bar, but you can see we have a big tail on the top of 32 and a tail on the bottom. It's still bear, 30 is really going to get a couple legs sideways to down. So we're probably going to get at least another leg sideways to down, but I'm not sure how much more to the downside. Let me just look at this real quick. Oh, okay, interesting. So I marked this as an OO pattern. Well, let me just get there. 33, a bad high 1 for the bull, or I guess you'd argue a big high 2 or high 3 or something like that. But after this probably resets the market cycle. So I would look at it as a bad high 1. Doji bar, probably sellers not too far above. And we end up getting an OOO pattern, 34, 35, 36. OOO is pretty rare, and so it increases the chances that we're going to get some sort of breakout. So I know I mentioned earlier that good trends usually start with some sort of strong signal bars, and this was not as strong, but the pattern was good. And here, obviously, the signal bar is not very strong, but an OOO pattern is a relatively special pattern. And so it's reasonable to buy above 36 and take a chance that this is the start of the breakout. It's been a trading range all day, and the problem is if you're buying, you are buying basically the middle of the trading range, which I tend to try to avoid. But we are also probably going to get some sort of breakout today. So you could take a chance here that the breakout is starting. But anyways, 34, another outside bar, but a bear close. 35, another outside bar, and another bear close, a bear bar closing near its low. So it's an OO pattern, which usually is going to lead to a breakout in either direction. And then we get 3 outside bars. The low of 35 and the low of 36 are the same, but close is close enough in the stock market, and it's pretty reasonable to just consider that the low. So, or the low and outside bar. So even though they are the same, you can consider it an outside bar. So OOO, a reversal up, and but a big tail on 36. So while we are probably going higher, I'm not sure how much higher. You can see we end up getting another tail on 37. So not the greatest start in the world for the bulls. The reality is the bulls who bought below bar 29 and are willing to scale in are probably going to make money. So that's good for the bears. Or sorry, that's good for the bulls. We're probably going at least a little bit higher. 38, another bull bar, but a tail on the top. So again, we're probably going at least a little bit higher, but there are pullbacks 36, 37, and another tail on 38. An inside bar, so a high 1 for the bulls on 39. However, it's a bear close. So how eager are you to buy above a bear bar? Probably not all that eager. However, the reality is the bulls who are buying above 39 or whatever, or buying the market for whatever reason, have a stop below bar 36, and they know that we're probably going to get the sell climax high, the bar 30 high. In trading ranges, you generally test magnets, and the bar 38 sell climax high is one of those magnets. We might also have to get back to the bar 19 close. Bulls who bought above bar 19, it wasn't a good idea, but it was reasonable considering how many bull closes we had. So those bulls should be able to scale in, and we should be able to get back into this area. You can see we rallied straight through it on 45. 40, an outside up bar, so good for the bulls. We're probably going at least a little bit higher. We created a higher low. An outside up bar in this context, if you think about it, we trade below 39 and then rally back above 39 and close above the breakout point, which is the 38 high. So this is its own breakout. And that means that that means that the low of 40 is technically a higher low. Does that mean you put a stop below 40? It's probably not great to do so, but you probably can. And again, 40 doesn't close on its high, which is disappointing, and it gaps down on the close of 40. So both of those things are disappointing. However, it is probably not unreasonable to buy above 40 and put a stop below it. 41, you can see we initially find sellers above. If you bought above 40 and you see 41, you just stay in the trade. It's trying to trap you out. The market tries to trap you out a lot, and you don't know that it's trying to trap you out, but you took a trade with reasonable risk reward, so it's reasonable to just let yourself get stopped out if you get stopped out in this context. Again, we're probably not going to rally straight up above 40 because the bar had a tail on the top and a huge tail on the bottom. Sometimes it'll happen with reversal bars, like bar 5. You don't exit below 6. You just can't do that. You can't buy above 40 and exit below 41. So 41, it's a little too short for the bears, but I'd rather not. You're selling right on the moving average, and I'd probably personally just rather wait. The channel up from 36 to 40 or 41 is also really tight. So for me, I would probably just rather wait and see what we get. Another outside up bar, 42, a bull bar closing near a high, strong enough that you can buy the close of 42 for sure. It's another one of those situations where it's creating its own higher low on a lower time frame. If I bought above 42, did not. But for safety purposes, I probably would just put my stop below 38. But it's probably okay to put your stop below 42 as well. 43, consecutive bull bars, but look at the tail on 43. It's a little bit disappointing. We're probably going at least a little bit higher, but you have to be careful because we are heading towards the top of the trading range. This is still a bull channel. Remember that. And we do have the nested wedge on the open. So if we run the stops from the nested wedge, which are above bar 20, we might get some sort of measured move up. And we did get a measured move up. It was just of the consecutive bull bars, 45 and 46. Second, need another sip of water. All right. 44, a bull bar closing near its high. It's good for the bulls, and we have a big tail on the bottom, which indicates the bulls were willing to buy the pullback. So it's not as good that we ended up getting this pullback. It also tests below the bar 42 low, so it tests, or high, it tests the breakout point. So if you didn't like the buy above 42, you decided to wait for 43, and then you got follow through and you tried to get filled on a limit order during bar 44, you were able to do so. So that leaves less bulls who are trapped out. So that's why you don't want to see that much overlap, because extra traders get trapped out. 45, a bull surprise. So this changes things. However, you have to be careful if you're buying up here. It's definitely reasonable to do so. It's really strong, so we're going higher. But you have to be careful because sometimes this will turn into a trap. So if you're going to buy above 45, you can honestly probably just put a stop below 45. If we trade below 45, your premise that this is a breakout is not valid. But it's still dangerous to do that. But I think if you're buying up here, you have to be willing to accept the fact that a lot of times you're going to get a big looking reversal bar like 24 that's going to be really disappointing. But this is not the case this time. So it's a breakout, and it closes above the high of the bar 20 nested wedge, which is strong for the bulls. And then we get follow through on 46. So we now have consecutive bull bars closing reasonably strong. Good for the bulls. We're probably going at least a little bit higher, and we might try to form some sort of measured move. Again, 45 is its own breakout. So this is a good channel, but we're getting a breakout above a bull channel. Maybe we get a measured move up of the bull channel, something like this, which is another target in that area. But it's reasonable to look for, you get a breakout above a channel, reasonable to look for a measured move up of the channel, something along those lines. 47, a bear bar, not quite closing near its low, but a low one short for the bears. Do you exit below 48 if you're a bull? You probably don't have to. It's a high one for the bulls, but it's not technically a high one since we never triggered below it, so it's still a bull micro channel. 42 through 50 ended up being a bull micro channel, so an 8-bar bull micro channel. So good for the bulls, but 48 is a very climactic bar. What was the target, right? So what were the bulls looking for here? Well, I thought the gap on the daily chart, obviously this is a triangle, so maybe we were just testing around the apex of the triangle, or maybe the high of the channel, something like that, maybe into this gap. I thought, the stretch target for the bulls was this gap down here. We're definitely going to close this gap. I think we're going to do it. Do we do it next week? I don't know, maybe, but I think that, we're going here most likely before we're going here. So I do think we're going up into this area and we're going to close that gap because it's trading range and gaps are going to close in trading ranges. I don't think this is the final low. I don't think we're just going to go straight up. I think we're going to revisit this area and back into 5,000, but I'll look into that in a minute when I get to the daily chart. So 48, a good looking bar for the bulls, but it's the best looking bar. So it might be climactic. Again, it's a huge bar. So it is reasonable to be long. It's probably reasonable to buy it. But it's been a trading range day so far. You are at a measured move. So I don't know. It might be more of a trading range bar. Disappointment 49, but 49 was a bull close. I thought that was important that bar 49 was a bull close because it is technically follow through. It's not amazing follow through, but it is technically still follow through. And we do have open gaps. You can see the bar 20 high has no overlap with the bar 46 low. It's a very tiny open gap, but this open gap is really important. It means the bears who were betting this was a trading range day and sold above the high all of a sudden got trapped, and now they're seeing this. So if you're a bear, you can't panic out. You have to stick to your premise that this is going to be a trading range day, and sometimes you're going to get really trapped, and that sucks. But it's reasonable to just continue to hold short. But it's disappointing, I think, that you get the bull close here for the bears because I think that this is considered technically follow through. So sometimes 50 is going to be another big bull bar, and that could lead to a really large bull trend. Instead, you get a bear bar on 50. Do you have to exit your longs below 50? I don't think you have to. You can for sure, but I do not think you have to. And you can see, though, a lot of bulls this time ended up exiting their longs below 50, and that causes 51. Now you should exit your longs below 51. The reality is the bulls who buy below 48, the buy climax, are going to end up making money. So it is reasonable to take the buy. It is reasonable if you're a limit order trader to buy below 48 and probably buy more at the breakout point. 51 makes traders think this is a trading range. So we're going back to the bar 20 high, which is the breakout point. 52, so 3 straight bear bars. We're probably always in short and probably going at least a little bit lower. 53, another big bear bar. So 4 straight bear bars, 50, 51, 52, 53. We're going to get a second leg sideways down. So the first reversal up is very likely to fail. But, at this point in the day, I don't know how much lower we're really going. The spike up from 36 to 49 was really strong. And this move down is relatively strong as well. So to me, it looks more like big up, big down, big confusion than anything. 54, a doji bar, an inside bar, a high one buy for the bulls, but I'm not really all that interested in buying above a bear bar. An outside bar, 55, but so probably sellers not too far above 55, 54 during 55, and then probably buyers not too far below 54. Could be some sort of parabolic move forming spike. So this is 1, and then it's pullback, and then 2, and then a pullback, and then 3. So it's spike, pause, and then not spike, but you kind of get the point. And then a bull bar, 56, closing your high. Do you buy above 56? I probably would not because you're buying against so many straight bear bars, so it doesn't really make sense to do so unless you have an uber wide stop, probably all the way below 36, and you're scaling in lower, betting we're going to get back to the bar 56 high. But if you're going to do that, we're not going to rally straight up, so why not just buy below 56 instead and use the wide stop anyways if you're taking that kind of trade. Outside down 57, possibly the second leg down from the initial bear move. And then 58, a bull bar closing your tie. Do you buy above 58? I still wouldn't unless you have a really wide stop. It's a high 2, but the bear channel down is extremely tight. These bull bars are closing near their highs. So 56 and 58 bull bars closing near their highs, but I don't know how much higher we're going. 59, outside down. Again, this looks like it's forming a trading range. Where's the top of the trading range? Probably the bar 55 high. Where's the bottom of the trading range? We don't know yet. There's going to be some sort of reversal up that ends up being the bottom of the trading range, but we don't know yet. 60, another reversal attempt up, but not able to close on its high. But there's going to be buyers below here is kind of the reality. Then 61, an outside bar. So we got an outside pattern here. So 61 and 62. Another outside bar 62, and you can buy above 62 breakout mode pattern. But the problem is you're buying high in a tight trading range, that started at 50, 58, and you're buying higher in the overall trading range. The top of the trading range, we had a spike down and then a channel. So the spike down to 53, and then, or you could argue 54, 55, and then the channel starts 55, 56. So you know the top of the channel is going to be where the top of the trading range is because the market cycle is spike channel trading range. And if you're getting spike channel, bear channel, so bear spike, bear channel, then the top of the bear channel is going to be where the trading range is, where trading range started. So the problem with buying above 62 is your probability is high, sure, but your risk reward isn't all that good. If you put a stop below 62, trying to make it back to the top of the trading range, the bar 56 high, you might need a wide stop and scaling in, but I'm not sure how much money you're even going to make doing that. This looks like a trading range for the rest of the day to me. Some traders, they don't want to buy above 62, so they wait for confirmation 63. And now they have consecutive bull bars 62, 63, but they can buy the close of 63 at the same price they could have bought above 62, but they have more information. So some traders will do that. And then you get follow through 64, but it sold off pretty quickly once it started to rally towards the 57 high, the buy climax high. So again, this just looks like a trading range. Buyers below 64, sure, but not great. I mean, lower high still. So if you're buying below, you can't be scared out by the bar you get on 65. You have to be willing to scale in lower and buy more lower here. 66, a reversal up. So 65 again. Some bulls giving up is probably what's causing 65. Some of the bulls were buying the close of 63, looking for 64 to just be some humongous bull bar that looks like 48. And they know that it's really, really unlikely. So a lot of them end up exiting during 64. And you can see the rest of them as 65 rallied to the 63 high, they exited there. 66, a higher low double bottom. We're probably going at least a little bit higher, but these are big bars, big risk, middle of the trading range. I think you start seeing the market do this on a Friday. At the end of the day, you're just done. Just be done with the day. And you can see we rally back up to the top of the trading range and then started selling back off, and we rallied. It ended up being a little bit higher because we had an open gap here. So the trading range ended up being with here. Do I think I think at some point we'll get back up to here, maybe next week. I don't know what the gap's going to look like, but assuming no gap, we'll probably form a trading range in this area, I would imagine. So for stop orders, you could take 5 for a possible low of the day. You could buy here. Still, this is possible low of the day. You could maybe sell 10, but it's going to be a minor reversal. Parabolic wedges are minor reversals, so it should lead to a higher low. 1 second. But still a credible high of the day. I would not buy anywhere in here. The nested wedges make sense to sell 20. I think you could sell 24, kind of the same way you can buy this. So it's probably not the best thing in the world, but it's still this credible high of the day, this credible low of the day. So you could still take the next big bear bar closing near, or big bull bar closing near its high. And here you can just take the bull bar closing or bear bar closing near its low. 000, so it's probably okay to buy 36, buy 42, 44, buy the close, breakout, buy the close, climactic. So maybe, and you got to be quick to get out. Maybe, maybe below 50 or 51, and then you could maybe sell these closes, looking for a second leg down, but it's tough. And I would not do anything here. Yeah, maybe you can do some stuff with this, but you're just scalping, and it's just difficult. It's probably just better to wait for tomorrow, and by tomorrow I mean Monday. So on the daily chart, I think we're trying to close this gap. This channel up is relatively tight, but it's probably going to be a minor reversal with how strong this was. So I don't know. Where do we retrace? Maybe a 50%. Oops. Maybe we go back to a 50% correction, which it's not a coincidence, guys, that basically around where the gap is going to close is where the 50% correction is. It's the algorithms creating a resistance zone. The weekly chart, obviously, the gap down counts as part of a bull bar as well. So you can consider this just a big bear bar. We could, if we look at it with extended hours. Whoa. That is the wrong thing. So yeah, just a big reversal bar. What is this going to lead to? A higher low, probably. So it's also interesting. We did get an 00 pattern on the daily chart, but this is not like the greatest follow through. So it's still possible. Like I said, if I was looking at this on a 5-minute chart, I would think we're getting into this area pretty soon. Before we get down here, obviously. So an 00 pattern, reasonable chance that we get. It's a breakout mode pattern for the bulls, but obviously this is a tight channel down. The weekly chart, bad reversal up. High 1 buy for the bulls. Is this going here before it goes here? I don't think so. I think we're going to get a lower high from these 3 bear bars. So we'll see when that ends up happening. But obviously a clear break of the moving average. It's the most, the strongest one we've had since last October for sure. So I'll be interested to see when we get first bear bar closing fully below the moving average and start to form a trading range. Again, I do think, I don't know what the leg 1, leg 2 is. I'm just having fun with it now because I was drawing them earlier. But No, I was hoping there'd be something into the 5,000 area. Maybe a measured move of these three bear bars. Still the same area. But anyways, monthly chart, again, I think this is going to end up being a minor reversal down because of how strong these three bull bars are. Had this been a bear bar closing near its low for the bears, it would have been an increased chance of some sort of reasonable looking bear reversal. But all right, that is going to be it for today's review.